Hi and welcome to this level 3 video coming from the Asset Allocation volume of the curriculum. It's the first one in the series and it's called The Framework for Developing Capital Market Expectations. Now, to give you a bit of an intro, it's inevitable that investors, analysts, members of the investing community will be forecasting the future. That's part of what we do. And forecasting the future basically means creating or building expectations, assumptions. Now, capital market expectations are precisely those expectations that we focus on in finance. So expectations concerning both the risk associated with various investments, but also, just as importantly, the returns that we may expect from them. So risk and return profiles, risk and return characteristics, but because they concern the future, I'm going to say the prospects, risk and return prospects, or indeed you could say projections, or you could just as well say, I guess, forecasts for those different asset classes that will be of concern to a specific analyst, for different asset classes. And what the number of those asset classes is for which an analyst or investor creates or builds these expectations or projections pretty much depends on the investable universe that is of concern to them. It will be different for a fixed income investor. It will be different for an equities investor. It will depend on whether they focus on the domestic market or global market. They will create subcategories of asset classes based on geography, but also asset, security or asset type. So let me highlight the notion of prospects or projections or forecasts. It's inevitable, absolutely inevitable, that when forecasting, we will run into forecast errors or forecasting errors. So forecast errors are probably, irrespective of how, probably inevitable, so unavoidable. And the goal of the exercise isn't necessarily to get everything spot on. The future will always surprise us. That's part of the beauty of finance. And errors are more likely to happen, or more likely to happen, the longer the investment horizon that you choose to forecast over, or the time horizon that you use. So especially over longer time horizons, our forecasts are likely to not to be realized, even if we use very sophisticated, complex, computationally or theoretically forecasting methods. So here's an important point. I think it's important because it can easily be woven into some kind of theoretical question. The approach that your book seems to convey, to promote, or to suggest is that whilst building these expectations, you shouldn't really concern yourself about getting things spot on. So there should be, let's say, less emphasis on the precision, the accuracy, the precision of individual forecasts for a given time, a given time period, let's say next year or in 2 years' time or in 3 years' time, and a specific asset class, let's say domestic equities. So precision of individual asset class forecasts. Don't put too much weight on that. And that's not to say do a bad job, ignore it, or have a lax attitude to it. No, do your best, but don't stress over getting it right. That's not necessarily the point. There should definitely be more emphasis, and this is, this is what you should be devoting definitely more time to, is on ensuring what what your book refers to as consistency of your forecasts. And there are in fact two types of consistency that we focus on here. One is cross-sectional consistency, and that means consistency of your forecasts across the different asset classes. So making sure they are coherent, that certain relationships hold, you normally expect to hold, for example, between the behavior of value stocks or, value stocks and other, let's say, types of stocks, or large caps, small caps, or high beta, low beta stocks, or maybe fixed income and equities. And the second type of consistency is intertemporal consistency, and intertemporal means between time periods. So this is consistency, of forecasts, but across time horizons. Now, what is the rationale for the focus on consistency as opposed to accurate precision of the individual forecasts? Well, this rationale, let me put this over here on the side, comes from, let's say, the use of the projections, the use of the capital market expectations. Why do we build them? Well, we build them to use them for a specific purpose. These projections are not going to be used as precise forecasts of how our portfolio will definitely behave. No, they will be used as tools, or as an input, used as inputs into the asset allocation decision. Asset allocation. Maybe I should have spelled or written allocation with capital letters as well, because it's part of the same phrase here. Asset allocation decision. And with the asset allocation decision, you're much more concerned about, what the interplay, what the relationship between different asset classes is going to be, as well as how it may also, how the performance in terms of risk and return may evolve over time. Not the precise forecast. That's not really important. So, it is less important, let's say, hence less emphasis on the precision of the individual asset class forecasts, more emphasis on consistency. Now, there are dangers lurking if one doesn't observe cross-sectional or indeed intertemporal consistency. If the first one is lacking, so if cross-sectional consistency isn't catered for, what the sorry result could be, or the unhappy result could be, is that you end up building portfolios, or your asset allocation decisions lead you to create portfolios with relatively poor risk return characteristics, because you don't observe the interplay between different assets in terms of the risk and reward properties. Now, on the other hand, if intertemporal consistency is lacking, then this could result in, once again, an outcome that you want to avoid, namely distorted a distorted connection, or a perception, or a view with a distorted connection between the constructed portfolio, so portfolio construction, and the investment horizon. you may end up being very unhappy at the end of your investment horizon when you find out that things did not develop over time as you may have expected it, because you didn't cater for this intertemporal consistency of your forecasts. So here is what essentially the brunt of this video is supposed to be about, namely the framework for developing capital market expectations. Your book obviously suggests a framework, and I've laid out the steps over here. We're going to go through them, but I don't want you to have to write them down. They're given here. And the idea is not, obviously, as always, at level 3 you should be used to this. The idea isn't to memorize these steps, but to make sure you appreciate the logic. So the first step in developing CMEs, namely capital market expectations, would be, first of all, to specify the set of expectations that you require, including also the time horizons that we're going to be dealing with. And this set boils down to a precise and explicit, as opposed to vague, list of assets for which you're going to have to come up with risk and return projections, for which risk and return projections are needed, and the time horizons, the investment horizons, over which those forecasts, those projections should span. And of course, that list of assets or asset categories will depend on what you consider allocating to your clients' portfolios, given the mandates that you've been given and policies being followed. Now, number 2, research the historical record. Obviously, these days, we are overflowing with data, historical data, and the idea is not to take everything, but identify those pieces of information which are going to be critical. And for that, you need to identify certain relationships. So you need to identify, I guess, what we would call the return drivers, the drivers of performance, those factors which determine performance in terms of both returns and risk. Then specify the models to be used, and the information requirements that those impose. There are different methods to assess what assets are going to likely, or what assets are expected to do. One method would be the discounted cash flow analysis, right, to suggest what may happen to a stock's value in the future, let's say. But the idea here is, there's just one simple message here. Make sure you match the method or, modeling approach with the investment horizon. Some methods lend themselves better to short-term forecasts of performance. Other are better for determining or trying to come up with longer-term expectations. For example, DCF is more associated with longer-term forecasting as opposed to short-term forecasting. So this is just a kind little gentle reminder here. Then determine the best sources for your information needs. Well, what database are you going to use, or what databases, what sources? How much money does that cost? And obviously here, one thing is you want the information to be accurate, but maybe you want it to be timely as well. Obviously, if you wanted to if you want to use that information to make ongoing investment decisions, what cost does that come up? What cost does that involve, for example? These are the types of decisions you will need to make. Is it worth to get information from that source? Maybe it's more robust, it's more clean, it doesn't, it contains less errors, that kind of stuff. Then, number 5, interpret the current investment environment using the selected data and methods. So kind of up to step 4, everything was preparation to do the actual forecasting. And well, basically, in step number 5, we get cracking. We interpret the current investment environment using the selected data and methods. So that basically means getting on with it and implementing our chosen investment or research process. Investment stroke research process. Run the machine, feed it with data and see what comes out. And then obviously provide the expectations, kind of synthesize your projections, the expectations that are needed, documenting your conclusions. So this is a step that your book elaborates on and says, oh, sorry for this little line. Okay, it's disappeared. Add designated time points, time stamps, at designated dates. Make sure you synthesize, aggregate your views, your expectations, that you document them as well. And you have arguments to defend them, defend your views in front of a committee internally, right? Or maybe in discussions with your investors, the providers of capital. Right, number 7 is something you should always expect to come up in CFA, kind of frameworks or steps lists, and that is a feedback step where we basically monitor the actual outcomes versus expectations. So monitor actual outcomes and compare them with expectations. And that is important because if we neglect to do that, how can we ever expect to improve our process? So that final step, very critical, provides feedback into the expectations setting process. Expectations setting process. Good. Let's just finish off. This is very much the end with some properties of good forecasts. If you follow these steps, improve the process, you'll hopefully come up with good forecasts. And good forecasts are ones that are unbiased. Namely, they're objective, they're not skewed to the upside or the downside, neither overly optimistic nor pessimistic. They should be efficient, your book says. And by efficient, at least in this section of the curriculum, what they are hinting at is you want to minimizing the forecast errors, of course, the gap between what was projected and reality. And finally, they should be internally consistent. And that's, a nod to what we already said at the top here. Cross-sectional consistency. You don't want to, let's say, over time, over the longer term, project that safe bonds will generate returns that are higher than more risky equities, and intertemporal consistency as well. So that's internally consistent forecast. And just on the point of intertemporal consistency, let's say, if you're modeling or forecasting the performance of a startup, you'll probably expect it to grow the fastest in the next couple of years, and then for that growth to slow down as there is more, obviously if the idea is successful, if there is more competition, if there are rivals copying the same strategy, obviously that should bring results down. It would be very intertemporally inconsistent to model later performance at a higher rate and kind of going into the future for some indefinite period than the performance in those early stages when the product and the idea is fresh.